understanding the dynamics of liquidity traps. A liquidity trap is an economic situation where monetary policy becomes ineffective because people prefer to hold onto cash rather than spend or invest even when interest rates are very low, because it characterizes the very low interest rates, high cash holdings, ineffective monetary policy, which maybe causes economic uncertainty and more debt overhang.
Implications of economic policy in a liquidity trap. Ineffectiveness of monetary policy. Traditional monetary policy tools such as lowering interest rates become ineffective because interest rates are already near zero. This limits the central bank's ability to stimulate the economy. And the second thing is need for fiscal policy. In such scenarios, expansionary fiscal policy becomes crucial. Governments may need to increase public spending or cut taxes to boost demand and stimulate economic activity. Quantitative easing. Central banks might resort to unconventional measures like quantitative easing, where they purchase financial assets to increase the money supply and encourage lending investment. Inflation targeting. Policymakers might aim for higher inflation targets to reduce the real interest rate and encourage spending and investment. Debt management. High levels of public and private debt can exacerbate a liquidity trap. Effective debt management strategies are essential to prevent deflationary spiral and support economic recovery. Example of liquidity traps. The Great Depression and 1930s. One of the most notable examples where despite low interest rates, economic activity remained stagnant due to high levels of debt and deflationary pressures.
Causes of liquidity traps. Extremely low interest rates. When interest rates are near zero, the people prefer to hold on to cash rather than to invest in low yielding bonds or other assets. High levels of debt. Both consumers and businesses may, on, may focus on paying off existing debt rather than taking on new loans, reducing overall spending in investments. Deflationary pressures. Expectations on falling prices can lead to delay spending and investment as people anticipate that goods and services will be cheaper in the future. Risk aversion. During economic uncertainty, investors and consumers may become risk averse, preferring to save money rather than spending on it. Lack of confidence in the economy. A general lack of confidence in the economy would be stability can lead to increased savings and reduce the consumption and the investment in the economy.